Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. You might or might have not noticed that I'm not at my usual studio today. I'm actually in Orlando in Hard Rock Hotel and Studios, getting ready to go to Universal Studios with the family. But as you guys know, I am a man of my word, and I always deliver what I promise. Now, I want to show you guys the market's going to be opening up in a little bit less than 2 hours, in about an hour and 55 minutes. I'm an eager beaver on to an early start. The Dow Jones is up about 144 points. The NASDAQ is up 83 points. But the most significant factor is this VIX. I want to explain to you why. This is really important right now. I want you guys to pay close attention. So if you're looking at the VIX, you will see that the VIX is breaking lower. Now, the VIX peaked out. This date is the 10th of this month. If you look at the chart, and I'm going to go back and forth here because I want to show you things. This is really significant. If you look at the SPY or the S&P or the Dow Jones, but I want to show you guys this. This is really important. If you look at the bottom, we bottomed out on the 20th, okay? On the 20th. On the 10th, we were down here, right there, okay? So remember this price pattern. This is the 10th, and this is the 20th. 10th, 20th. Now look at volatility. This right here is the 10th, and this is the 20th. So volatility actually went higher before the market bottomed out, like right here, like about 10 days before the market bottomed out. But what I like is we've been sticking around this level right here, this head and shoulders level, and we finally broke down. That's the futures contract. On the cash, I want to show you this. This is really important because if we can break these levels down, see this thing that's been building, this descending triangle? We're right here right now, like right below this level. If we can break lower, on volatility, that would be a very, very bullish sign for the overall market. That would give us a good indication that the market is, in fact, going higher and not lower. Now, if we break down right now, that volatility level is going to go higher. But right now, I like the fact that we already broke past the neckline right here for the last 4 sessions, and it does look like we're going higher. Now, on the Dow Jones, let me just kind of look at the same thing. And again, maybe I'm jumping the ship a little bit, or jumping the gun a little bit, not jumping the ship. I don't want to jump the ship. Nobody's jumping the ship around here. But you could see here that we are, in fact, making these levels. So if we break out and go a little bit higher on the Dow Jones, this will be very, very instrumental. Now, don't get your hopes up till we're at the 34,000 level or the 34,600 level. But, if this VIX continues moving lower and breaks down this level today, and I'm not kidding, I usually show this to you in this type of a graph. Here, let me show you. I usually do this area chart, but I wanted you to see the actual tick by tick because right now, oops, let me just go back to candlesticks because right now we're literally right there. So if we see it's breaking down, A, we have a short position in this asset, so it'll make us money. But B, if this goes down, that means markets go up. Another factor that I want you guys to pay attention to, and I thought it was maybe my imagination, but look at how long the bond market has been moving sideways now. This is very, very significant, and it's one of the reasons why the communication sector stopped going down and is actually starting to move sideways, very much like the bond market. And also, it's causing the chip stocks to start moving sideways too. So believe it or not, even though the markets are not behaving every day the way I want them to, things are looking better. But you got to keep your eye on the volatility. I'm telling you guys, this volatility, if this breaks lower, the more this breaks lower, the more confidence the market has in the bulls. So for the next day or two, it'll be very, very important to watch the VIX to see if it breaks lower. I think this will be the most important indicator, actually, in the next couple of days. So as far as news, we've got jobless claims, we've got factory orders, we've got ADP employment data. The only thing that really matters right now is the jobless claims and tomorrow's employment situations. Those are the big reports, although factory orders will be significant. But again, right now, everybody's focused on the major levels in the market. Now, let's talk a little bit about global economy. Oil fell more than $2 a barrel ahead of the OPEC meeting that's set for actually today, I believe. Supply bottlenecks persist. Strict COVID restrictions in China are back in Hong Kong as infections rise. I mean, I think they backed off for like a day while they're gradually being lifted in Shanghai. So they're increasing in Hong Kong and they're being lifted in Shanghai. That's bad. China has struck a zero COVID strategy that requires lockdown, mass testing, and all that crap that everybody who's listening to this video is intimately familiar with at this point. Daily market swings of 700 points on the Dow have been very, very typical as the U.S. Federal Reserve may force American economy into a recession, although I don't think they are. They're already talking about not going as aggressive in September. Fed has signaled that it may continue rising its short-term interest rates by double the usual amount at upcoming meetings in June and July. Speculation built last week that the Fed may consider a pause at its September meeting. That's one of the reasons why the volatility index is moving slightly lower, which helped stocks rise. But such hope diminished after Wednesday's manufacturing report from the Institute of Supply Management. It showed manufacturing accelerated last month, contrary to economists' expectations of a slowdown. That's not a bear market, folks. A separate report said that the number of job openings across the economy ticked a bit lower in April. So more manufacturing, lower job openings. That does not look like a recession to me, but remains much higher at 11.4 million than the number of unemployed people. On Wednesday, markets the start of the Fed's program to wind down the trillions of dollars that are coming into the economy. So right now is Thursday. What I want you guys to pay attention to more than anything is this level on the Dow, or the S&P, 417.50, 419. If we can break above this level, VIX is going down. On the QQQ, that level on the QQQ is 313. 313. Now, looking at individual sectors, the only one that really looks strong right now and stable is the energy sector. Healthcare looks like it's kind of choppy. Utilities looks like a little choppy. Consumer staples looks like it could be heading down for another downside move. So everything looks kind of neutral right now. Actually, things look slightly bearish if you want me to be honest with you, across the individual sectors. But energy's still looking good. Therefore, I'm going to recommend that you guys stick with the energy sector until things get better. And I really, really like the energy sector. This deals with natural gas and energies. Prices have been moving solid, and they've been moving higher. I would look for an expiration around September, and I would look for a strike price of right about 85 to 90. And yeah, 90 looks good. And if you want to spread, buy the 90 and sell the 100. You'll get plenty. This will be like a $3.50, $4 spread. Not bad. And you have all the way till the end of September. Now, as far as individual stocks are concerned, let's take a look at the S&P real quick. You still have Oxy, Marathon, Energy. All the same stocks that were leading are exactly the same stocks. Nothing has changed in months. Look, all industrial. We had a little bit of the broad market come in here, but it all went back to energies. Energies. Here you have a little bit bag of nuts, but look at the top. All energies. And on the bottom, you still have you have a lot of retailers, a lot of communication stocks, and a lot of consumer discretionary stocks. And look at the Carnival, Royal Caribbean, Target, Norwegian. People are not traveling on cruise ships, and they're not even thinking about it right now. So let's stick with these sectors for now, for the time being. Energy, utilities, healthcare, materials, consumer staples. These right here. And if you want to short these sectors. Honestly, I would stick to the top three: energy, utilities, and healthcare. And I would short technology and consumer discretionary. I would leave communication services out of it for now. Now, folks, before I let you go, I want to tell you something important. My speaking skills are... Folks, the Federal Reserve is stuck. They're literally stuck right now between a rock and a hard place. Inflation is at a four-decade high, and it's causing big money to rotate out of tech and speculative growth stocks and into more recession-proof stocks like energy, consumer staples, utilities, and so forth, because they tend to do well when the rest of the market is shrinking. And this massive rotation into defensive stocks is happening right now. I mean, we've been talking about it for months. Click on the link below and learn exactly how to spot these stocks and how these stocks are primed to rip during the next market drawdowns. Because remember, defensive stocks go up when markets go down. Tomorrow, oh boy, you're in for a treat. Weekly recap, biggest winners, biggest losers, and what to expect next week. And I'll talk to you guys later. I'll be here tomorrow, and I'll see you later in my VIP program. I'll be there today every step of the way. Feedback, comments, post some comments under this video. Send me some love letters. Support@marketgeeks.com. Bye. Have a great, great day.